So this is ongoing, and if I'm right in what I've laid out, the economy is slow right now, we're in recession, it will recover next year, and we'll be in the sweet spot where the economy is recovering, earnings are coming back, so that's 2024, earnings are coming back, but inflation is falling and unemployment is rising. That leaves the central bank injecting liquidity in an election year where the government will stimulate, and that's going to create a very powerful boost for the markets. The central bank balance sheet usage will debase the currency. So you're looking for assets that could do the best in this scenario. So for me, the assets that do best is the exponential aid, anything technology related, along with cryptocurrencies. And my chosen horse to back the most is crypto.
Currently, there exists a divide among economists and analysts regarding our economic status. Questions such as whether we are in a recession, whether it will worsen, or if a crash is imminent have become prominent. Macro-economist and Real Vision founder, Raoul Pal, offers a clear perspective. He argues that the answer is apparent. Markets had already priced in a recession in 2022, and that marked the bottom. Now they are looking ahead, projecting 12 to 18 months into the future. As liquidity returns to the system and interest rates fall, Pal predicts that prices will rise. In response to this outlook, he has made crypto and technology stocks his preferred investments, expecting them to outperform other assets significantly. For a deeper understanding of his bullish stance, be sure to watch the entire video where Raoul elaborates on his reasons.
But the spoiler alert for me is I'm really bloody bullish, and I've been bullish all year, and I was starting to get bullish at the back end of last year, and so far that's played out well. My main bets have been crypto and tech, and they've both had phenomenally good years. In fact, the Nasdaq's had one of its best ever starts to its year. Now, does that mean I'm going to be right going forwards? Who knows? I think I've done the homework. I think I know where we are, but obviously things can change. I also think that there is always volatility involved in markets as well, and the market's job is to try and throw you off. Right now, generally speaking, most people have missed the massive rally in equities, and so they're hoping that the market comes lower. So we've seen that from the institutional surveys. People just haven't been involved. So a lot of it's been retail and passive money, index funds, stuff like that, without people actually making money from it. And that's always interesting to me because we come into year end, and it tends to mean that somebody's going to have to make a decision how they want to report to their investors at the end of the year. And the pension funds and others don't want to show that they were massively underweight equities all year. But let's see how that plays out. I've got some strong views about the rest of this year as well. So without further ado, let's go through some of this. So firstly, let's think about growth element. Where the hell are we? Now, many of you have seen this chart of the GMI business cycles dominoes. And this is really important to understand because, as Stan Druckenmiller says, you never trade today's news. You need to understand which part of the cycle is driving the asset prices and which part of the cycle is driving the Federal Reserve. So on this, myself and Julian Bittle, who works with me at Global Macro Investor, well, our job is to live as far out as possible. So we're in that 8 to 10 months area ahead where we're looking what's happening to the cycle. We actually go further out, but the bulk of our business cycle work, as opposed to our secular work, is this 8 to 10 months out. Now, the markets have been roughly trading 2 to 4 months ahead of the business cycle. In some cases, stuff like technology and crypto, they've actually been even further ahead than normal. And then we've got the central bank. Well, they're lagging with the ISM. If we take the ISM as where the economy is today, because it's basically a real-time GDP indicator, well, the central banks, well, they're looking for CPI to come down and unemployment, and those things are really lagged. In some cases, 6 to 8 months. And when we get down to the big inflation stuff like shelter inflation and wages, I mean, they can be over a year, sometimes 2 years lagged as that keeps changing. So, okay, that's now you understand where we are. Right now, the ISM. The ISM gives you the snapshot of where we are, and it's been around this kind of 46, 47 level for a while now. Now, that's a really important level because historically, that has pretty much had a 100% chance of recession. And I think most of us realize we've had a recession. I think most businesses have seen a slowdown. I think many people have laid off jobs, and we're seeing, and I'll come on to jobs later, a change in the job structure. But that recession has not been called yet. We've seen the economic data, the GDP data, still somewhat buoyant. But I think it's there, and I think when all is said and done, the recession will have been called during this year. But here's the rub. I think it's actually about to start becoming over. Now, again, I'm using the ISM. The ISM leads GDP because that's lagged by 3 months. So therefore, by the time the ISM gets positive, which I think is coming, and I'll show you that in a sec, that's all going to play out kind of Q4 to Q1. But the point being is we are at the trough of the actual cycle right now. So if we look at what we use as our main indicator, the GMI Financial Conditions Index, it has a 9-month lead. Now, this Financial Conditions Index is a blend of the dollar, commodity prices, and rates. markets. Now, it led the whole cycle, suggested the ISM is going to recover by a significant portion of time. It also gave us the trough 9 months prior. So we've known roughly when the ISM was going to trough from using our indicator a long time ago and what that was going to do to financial markets. You can see, interestingly now, it's rolling over somewhat. That's based on the fact that the dollar's gone up recently and rates went up recently. So it tells us something that we may see growth slow down or have a soft patch later in 2025. But anyway, let's not get ahead of ourselves. We're focusing on now, boom, bust. Is that crash or are we in a next bull market idea that I want to go through? So as opposed to our GMI financial conditions, let's use something more traditional. Let's use the ISM new orders minus inventories. It basically has a 3-month lead and it's saying that ISM is about to start recovering fast. In fact, in the last quarter, ISM may well trade above 50 and show the economy's in expansion again, which is not what people are expecting. Now, I think people are all chewed up on, is this a recession, not a recession? It doesn't really matter to me. You see, the key thing is the market's priced it in last year. And I know that people struggle to understand this, but the NASDAQ priced the ISM at something like 37 last year. It was a terrible year for equities, and it priced in a full recession in advance because it's leading the ISM. In fact, the NASDAQ has been a really good lead, and it's a bit further out than usual. In fact, if we look at it versus our financial conditions index, it lags that by about 6 months, but you can see it's been following it pretty closely. So as financial conditions ease, that's the blue line going up, the NASDAQ went up with it, and it forecasts further out that we've got further rises in the NASDAQ to come. But you can see financial conditions get a bit choppy going forwards because of what we've seen with interest rates and what we've seen with the dollar. But I think that will resolve itself in lower yields and lower rates. I'll comment on why the lower yields later. So this is why I remain bullish, and we'll go further out. So let's not get ahead of ourselves. First, liquidity. Liquidity matters. And our GMI Weekly Global Liquidity Index actually lags our financial conditions index by 5 months. So that's very useful. It tells us liquidity is going to keep rising. It's going to keep rising well into 2024, where we might get this little air pocket. But don't concern yourselves with the wiggles. They don't mean a lot. Overall, directionally, we should be headed much higher in the global liquidity cycle. So that's what I'm expecting. So therefore, I cannot be a bear, because if there's excess liquidity, you're debasing the currency, so optically asset prices rise. And the assets I'm long are the secular trending assets. So those are the ones that naturally go up, like the NASDAQ and cryptocurrencies. Those ones are in a natural secular cycle, so they will continue to go up. Now, some of you might go, well, Nvidia, that's so expensive, it's overvalued, blah, blah, blah. I don't care. It's liquidity that drives everything. We only need to worry about that stuff at the end of the next cycle, when inflation is coming back and rates are going back up. We're the opposite of that right now. We've got a lovely 18-month period of rate cuts, stimulus, and all of the good stuff. That's what you should be focused on. You shouldn't be focused on these other red herrings. They only matter when the cycle rolls over, and that's not for a period of time. So this is ongoing, and if I'm right in what I've laid out, the economy is slow right now, we're in recession, it will recover next year, and we'll be in the sweet spot where the economy is recovering, earnings are coming back, so that's 2024, earnings are coming back, but inflation is falling and unemployment is rising. That leaves the central bank injecting liquidity in an election year where the government will stimulate, and that's going to create a very powerful boost for the markets. The central bank balance sheet usage will debase the currency. So you're looking for assets that could do the best in this scenario. So for me, the assets that do best is the exponential aid, anything technology related, along with cryptocurrencies. And my chosen horse to back the most is crypto, because that benefits very well liquidity cycle, yet it has the secular trend behind it. Let's say that you're not one of those people. You don't like technology, you don't like NASDAQ. Well, at some point soon, you will definitely get a cyclicals rally. So you'll probably get it in oil stocks. You'll get it in the oil price itself. You'll get it in a whole bunch of different areas of the economy. Could be banks, and that's fine too. I'm just looking to maximize my returns, and that's why I've chosen these particular vehicles. I don't see a world where we get another crash unless we've got something like China invading Taiwan. That's the favorite everybody's got. Surely we can worry about that all day, but let's play that out. China invades Taiwan tomorrow. What happens? Market's down 30%, right? Good old-fashioned crash, panic. Oh my God, nuclear war. COVID taught us the outcome. Print more money. Markets scream back. And it's not about, oh, people are stupid, they're buying things at high price. No, it's the denominator effect. It revalues those assets. So this is why Yellen says there can't be another financial crisis. I do expect potentially some soggy period, maybe Q1, where this leading liquidity stuff slows down somewhat. Of course, we will see that. We can't keep screaming higher like we've been screaming higher. But I don't see anything that suggests that the market hasn't priced in the recession. I do an enormous amount of work on this. It's priced it in already. It's looking through the other side. Markets are forward looking. As Stan Druckenmiller says, never trade today's news. You've got to trade 6, 12, 18 months into the future. That's where markets trade. That's what interests markets. They don't look at today's news. So trading on Nvidia's earnings today or Apple's earnings today is also nonsense. You need to extrapolate, forecast, guesstimate where you think they're going and place your bets accordingly. So for me, in this side of the argument, I firmly come down on the side of the bulls. And I've spent an enormous amount of time putting this thesis together. I was never naturally a bullish guy. I'm a macro cynic, but this is the most cynical expression of everything, is yes, the great game is being played. The game is debasement. The game is to mutualize those interest payments amongst everybody by devaluing the currency. So if I know the game, I know how to play it.
Pal delves into the current economic landscape and outlines why his optimism for cryptocurrencies and technology in the upcoming quarters is unwavering. The convergence of economics, market analysis, and the rapidly evolving realm of cryptocurrency presents a captivating and dynamic terrain to explore. If Raoul Pal's bullish outlook resonates with your investment perspective, delving deeper into these interconnected domains could potentially unveil a wealth of lucrative opportunities. Understanding the interplay between these factors is key to navigating this complex landscape. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.